Hello, and welcome to the Joe DeLisi Financial Advisor podcast. This is going to be a timely podcast this week. It was actually written and was going to be recorded before this week, before we had some, let's just say, volatility in the markets. This one's also going to be just a tad bit longer. Normally we try to keep these around 9 minutes or so. This one might be just a little bit longer, so stick with me. There's some data in here you really, really need to grab a hold of and listen to. So over the past few weeks, we've been discussing the presidential election, and we're going to take a break on that for a while, mostly for my mental health. And we're going to discuss something that pairs really well with the topic that we actually discussed on the June 23rd podcast, which was sequence of returns risk. Now, for a business owner or a W-2 income employee, the day you exit the workforce is a day that should be the culmination of at least 7 years of detailed planning. And although the longer we have to plan for you, the better. And one reason for this is that you may have a reliance on stock market returns that could dictate the success of your retirement. And the longer that planning runway is, the less the market will dictate that success. However, no matter what we do, in most cases, the market will indeed have at least a partial effect on your timing and the relative success of your retirement. So that being the case, today we're going to dive into a topic that's crucial for every investor to understand, which is the recovery rate of return needed in the time required to bounce back from stock market losses. And when markets crash, they still retire. Now, we had clients retiring in 2002, 2008, and 2020. A crash should not be a reason for extending your working years. We're going to explore how a diversified portfolio, particularly one including U.S. small cap and value stocks, can help mitigate losses during these downturns. Again, this is timely. We had a very, very difficult opening to this week in the stock market. So, listen to this with that in mind, with Monday in mind. We're going to use relatively recent 2000 to 2002 market downturn as a case study and compare the performance of an all S&P 500 portfolio, which a lot of you have that aren't working with me so far, to a diversified one. This market downturn really is the best one to use as it lasted 3 years and would test the patience and courage of even the most resilient investor. Now, I was still a young advisor when that occurred. I was about 3 years into the business, but I remember that time period so well. So for me, it's still, recent memory. Again, market downturns can be unsettling. Whether you're seasoned or just starting out, seeing your portfolio's value drop, and it can feel like a real punch to the gut, and even more so the closer you get to retiring. But as you probably know, history has shown us that markets do recover. The key is understanding how recovery works and what it takes to get back to your original position. So let's start by discussing the math behind recovering from losses. Okay, so if your investment portfolio drops by a certain percentage, you actually need a larger percentage gain to get back to your original level. So if you drop 20%, you don't just have to gain 20% to get back to even. Actually, if your portfolio would decrease by 20, you would need a 25% gain to get back to recovery. And the deeper the loss, the steeper the required recovery gain necessary. Okay, so here's a breakdown just to give you some other numbers on that. So a 10% loss would require an 11% gain. A 20%, like we said before, would require 25%. A 30% loss would require a 42% gain. A 50% loss needs a 100% gain. So now let's look at some historical data to understand, well, how long does it typically take for markets to recover after significant downturns? An 11% gain off a 10% loss may not take you that long, but a 30% loss requiring 42%, how long could that take? Well, the stock market's experienced numerous corrections and a lot of bear markets over the last century. And as we saw a minute ago, the deeper the loss, the steeper that recovery required. The steeper the required recovered, the longer it may take. Here's some history. During the Great Depression, which everyone loves to talk about, the U.S. stock market lost nearly 90% of its value. 90%. It took about 25 years for the market to fully recover. So we're talking from the 30s to the 50s. It took a long time. It took almost a generation of investing to recover. The 1987 stock market crash, also known as Black Monday, saw the Dow Jones Industrial Average go down by about 22% in one day. Now, despite that severity, that market recovered to its pre-crash levels within about 2 years. That early 2000s bursting of the dot-com bubble, with the NASDAQ losing around 78% of its value from its peak, that took almost 15 years to fully recover. That's noteworthy. Right? As many new clients to me come in with heavy S&P 500 and heavy tech weightings, just like we were seeing in 2000. Again, I want to say that a lot of people's portfolios are built very similar to what we saw in 2000s. I'm not predicting anything. I'm just making a comment on what we're seeing. Here's another one. The 2008 financial crisis. The S&P 500 dropped by about 57%. Now, what's amazing is the market recovered its losses by March 2013, about 5 years after that crisis began. The craziest one I've seen, the 2008 was a pretty quick bounce back actually, but the craziest one was obviously the 2020 pandemic, when the S&P lost 30% in about 3 weeks. And then it recovered all of its losses and actually posted a gain all within 7 months. It was just sort of a whipsaw back and forth. Kind of a different scenario, obviously, than 2008, 2000, etc. Now, of these examples, I want to go back and single out the bursting of the dot-com bubble from 2000 to 2002. Now, again, this market slide lasted 3 years, and the NASDAQ lost 78 or so percent of its value, and the S&P was down about 49%. Now, to say this was a challenging time for investors and advisors, particularly those invested heavily in tech stocks, is to put it lightly. And again, to underscore the point, many investors are very heavy S&P 500 right now, which is very heavily influenced by tech stocks, a lot like 2000. But what about those who had diversified their investments? So let's compare the returns of this is really important. If you're driving, if you're kind of running or something, listen to this. I want you to really pay attention to this right now. This is a big piece. So again, we saw those large losses in the NASDAQ, 78%, and the S&P down almost 50%. But what if you had a diversified portfolio? So we're going to go compare. We're going to look at the returns of an all S&P 500 portfolio with a diversified portfolio containing an equal balance of number 1, S&P 500, number 2, U.S. small cap stocks, and number 3, U.S. small cap value stocks. Okay, so during that downturn, the S&P 500 index, which is primarily consists of large cap stocks, dropped, as we said, 49%. This index, as we mentioned, heavily influenced by the tech sector, just like it is today. You hear me say this over and over again, it's for a reason. Because that's where we suffered significant losses in portfolios. In contrast, an equally weighted, diversified portfolio consisting, as we said, of S&P, U.S. small cap. I'm going to use the Russell 2000 index for U.S. small cap stocks. And then I'm going to use the Fama French U.S. Small Value Research Index for the small value. That did a lot better. Here's the data. S&P down 49%. Russell 2000 index, again, small cap growth stocks, was up about 0.87%. Fama French U.S. Small Value Index, that's that small cap value stocks, that was up almost 12% over the same amount of time. So if you had a $3 million investment and it was all S&P 500, by the end of the downturn, your account value was from $3 million down to $1.87 million. Now that would definitely affect your retirement plans, but allocating 1/3 of the portfolio to each asset class we mentioned, that diversified portfolio would have been worth $3.04 million. Modest, about a 0.5 percentage point gain over that same time. But which would you prefer? A 49% loss or a modest gain over the same amount of time? And which one would a soon-to-be retiree prefer? Had you been heavy in the S&P 500, your losses would have been substantial. And the time it would take to recover could very well derail your retirement plans. We saw that back then in the early 2000s. Remember, if your investment portfolio drops by a certain percentage, you need a larger percentage gain to get back to your original level. The example from 2000 to 2002 clearly demonstrates the importance of diversification. While the S&P 500 alone suffered a nearly 50% loss, adding the small cap and the small value stocks to the mix saved an investor from an overall decline. And this happened because small cap and value stocks, they often have just very different market dynamics and were much less affected by the bursting of the tech bubble. So what should investors do as they begin the planning required to retire? Number one, have a very specific roadmap that will dictate where income will come from and when. So I use a very specific calculation. We refer to it as the cash flow simulator to do this for you. So if you're a client of mine who's in retirement or close, you've seen it. If you haven't yet, let me know. We'll walk you through it and show you exactly what that looks like. Again, it's a roadmap that will show what buckets are we going to pull that income from and when are we going to pull it from? In what time, what order. Number two, have a detailed investment policy statement that you and your advisor follow. If you're a client of mine right now, you have one of these. Even if you haven't read it, you have one of these. And this statement should reflect the science required to build a proper portfolio rather than reflecting a plan that's going to allow the advisor or you to speculate and gamble with your money. Number three, diversify across asset classes. As demonstrated by the resilience of small cap and value stocks during that 2000 to 2002 downturn, diversifying across asset classes can protect against the poor performance of any single sector. Many investors are invested in assets today, hear me again, that mirror what we saw in 2000. Now is the time to look at your holdings. Market downturns, which again, they can be very scary, are a natural part of investing. History reassures us that recovery is not just possible, but probable. But the key is patience, discipline, and a well thought out investment strategy. Diversifying across asset classes, including U.S. small and value stocks, can provide a buffer against losses and possibly enhance recovery potential. The key takeaway for you today is this: retirement should happen. It should happen on your timeline, not the stock market's timeline. We can help you make that happen using time-tested scientific portfolio construction and not by speculating or gambling with your money while chasing hot stocks or sectors. Now for the fun compliance piece. Let's start that again, but it's compliance, so we're going to have fun with it. Registered representative and financial advisor, Park Avenue Securities LLC, Pass, OSJ 5280 Carroll Canyon Road, Suite 300, San Diego, California 92121. 619-684-6400. Securities products and advisory services offered through Pass, member FINRA, SIPC, financial representative of the Guardian Life Insurance Company of America, Guardian, New York, New York. Pass is a wholly owned subsidiary of Guardian. Westpac Wealth Partners, LLC is not an affiliate or subsidiary of Pass or Guardian. Insurance products offered through Westpac Wealth Partners and Insurance Services, LLC, a DBA of Westpac Wealth Partners, LLC. California Insurance License Number OD34103. This podcast is for informational purposes only, not intended to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that the individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated or endorsed by Pass, Guardian, or Westpac Wealth, and the opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. Diversification does not guarantee profit or protect against market loss. Equities may decline in value due to both real and perceived general market, economic, and industry conditions. This material is intended for general use. By providing this content, Park Avenue Securities LLC and your financial representative are not undertaking to provide investment advice or make a recommendation for a specific individual or situation or to otherwise act in a fiduciary capacity. Past performance is not a guarantee of future results. Indices are unmanaged and one cannot invest directly in an index. 2024-179175 expires 8/2026.